Hello guys, this is Vinit from Edge-Forex and today is the July 24th, 2025 and today I'm going to talk about tariffs, inflations, how it kind of fits together. And if you ever wonder, like recently, I am sure you must have wondered why your grocery bill, your car prices, or even that new pair of sneakers is creeping up. Tariffs might be the culprit. Today, I'm breaking down why tariffs are inflationary, what companies are doing to cope, and what it means for your wallet and your trades. So let's get started. So let me move to the next slide. Okay, what are tariffs? It's a tax that is slapped on imported goods, and right now we're dealing with 10% tariff on most imports and a hefty 30% goods from China, thanks to Trump's administration policies that he rolled out in a few months ago in 2025. There are some exceptions like smartphones and pharmaceuticals, but these tariffs hit a ton of stuff from electronics to clothing to car parts. So why does it matter? Why tariffs are like a hidden tax that fuels inflation? So here how it works. When a company imports goods, say a retailer like Walmart bringing in toys from China, they have to pay that 30% tariff. That's a big hit to their cost. Most companies are not going to eat that expense and take a profit cut. Instead, they pass it on to you, the customer, by raising their prices. It's like a domino effect. Higher import costs mean higher prices at the store. No company is going to take that burden on. It's always going to pass it to people like you and I. For example, the National Retail Federation estimates that tariffs could cost U.S. consumers $78 billion a year in higher prices. That's real money out of your pocket, and it just doesn't affect the U.S. It affects the entire globe, and we'll get to that. So let's go to the next one. Okay, so it's not about just imported goods. Tariff, they mess with the supply chains. Let's say the U.S. car maker like Ford imports steel from Canada or Mexico. A 10% tariff on steel bumps the production cost, so the price of that new SUV goes up. And here's the kicker. Even domestic companies that don't import might raise that prices. Why? Because tariffs reduce competition from cheaper foreign goods, giving local producers room to charge more. So economists call this price stickiness. Once prices go up, they tend to stay up, even if tariffs ease later. How many times have you seen a car company saying that, hey, we're reducing a new model with more features, but cheaper prices? It never happens. From a trader's perspective, this is huge. Inflation was already running at around 3% in 2025, and tariffs are pouring full fuel on that fire. Higher prices mean the Federal Reserve might keep interest rates elevated to cool things down, which strengthens the dollar but can hurt equities and commodities. If you're trading Forex, keep an eye on USD pair. Tariffs good drive volatility. Okay. All right. So how are companies handling these tariffs? Most are passing the cost on to us. A recent survey from Allianz found that 54% of U.S. companies plan to raise prices to offset tariffs, while only 22% can absorb the hit. So let's look at some real-world example to see this in action. Okay, guys, one sec. Let me bring that down. Okay, corporate responses. So first up, retailers like Shein and Temu, these like real cheap goods producers and shippers from Chinese e-commerce companies, they are feeling the pinch from the 30% tariff on Chinese goods and the closure of the de minimis loophole, which used to let packages under $800 slide in the duty-free. Starting April 25th, both announced the price hikes. For example, Temu raised this patio chair from like 61 to 70. Shein bumped their prices, and there are not like 1 or 2% hikes. These are like doubling them in some cases or even more. in some cases. Nike. So let's talk about Nike. They're planning what they call a surgical price increase starting fall 2025 to cover $1 billion tariff for the fiscal year 26. Apparel and equipment will go up by every piece will go up by $2 to $10, and footwear will go by every pair would go by $5 to $10, and the new pair of those Air Maxes probably even pricier. Nike is a global brand, but even they can't dodge these costs entirely. So these things are bad, guys. Walmart, like they're the king of low prices. They're also raising prices on toys, electronics, some groceries like bananas, avocados, and coffee because they have to import them from South America. They're holding off till another month or so when the pre-tariff inventory runs out, but the price hikes are coming. Imagine paying more for your coffee. That's the tariff effect. It's going to hit everything, and it's going to hit everybody. If you think it's an American phenomenon, no. Think again, guys. It's not an American phenomenon. It's a worldwide phenomenon. In the auto world, Ford is bracing for $1.5 billion tariff hit in 25 and plans to raise car prices by at least 2%, 1.5 to 2%. General Motors reported a $1.1 billion impact on Q2 alone, and they will pass those costs on to the buyers. Subaru has confirmed price hikes, but they're not that specific. Cars are already a big purchase, and these increases could make that new ride even tougher to afford. So then there is Procter & Gamble, the folks behind Bounty paper towels, Tide detergent, household goods, cleaning things, cleaning supplies, kitchen supplies, bed sheets, you name it, your toothpaste. Everything is going to go higher when these tariffs actually come into play. Same goes for Stanley Black & Decker, who have already hiked their tool prices by single high digits in April 2025, with more planned in the upcoming months. Smaller companies, even companies like they make guitar strings, are raising prices to cover their millions and million dollars in tariffs. So not everybody is passing the buck. Right now, Home Depot has not announced anything, but doesn't mean that it won't. And the other company, spices company, Burlap and Barrel, they have capped as to how much they'll pass it on. And these are exceptions. They are not the norm. So take that with a grain of salt. Just because they're saying they won't do it, I don't buy it for a single minute that Home Depot is not going to pass their costs down to the consumers. So what is the impact on you and I, who are the consumers, who are going to be paying these hefty prices for these tariffs? Consumer, again, expect to pay a lot more for things: clothes, cars, electronics, your morning coffee. Average household could see an extra $1,000 to $2,000 in annual cost, depending on how much you buy from tariff categories. Okay, the less money for savings on investments, which isn't great for a growing economy or economic growth. For traders, tariffs are a double-edged sword. On one hand, they strengthen the dollar because higher inflation might keep U.S. interest rates high. That's good for USD bulls, especially against currencies like euro or yuan. But on the flip side, tariffs can slow global trade, hurting corporate earnings and spook equity markets. Look at companies like Nike or Ford. Their stock prices could go down if consumers push back on those price hikes. So again, guys, dollar bulls. Everything is about the dollar. It's the king dollar and gold. Again, I keep talking about different things, but at the end of it, we need to look at it as a Forex trader. How is that going to affect me? How is that going to affect my trades in the long run? Am I going to take a hit? Am I going to make money? How is it going to affect me? And how do I make sure that I am ready for that? So another thing to watch is the supply chain. Okay, guys. So, yeah. Okay. So other thing to watch is supply chain. Tariffs are pushing companies to rethink where the source good. Mattel, for example, trying to cut reliance on China for Barbie toys. Okay, where do I have the right one? Yeah, I do. Okay, but it takes time and money. So that's gonna take uh that's gonna mean on the short term the profits are gonna take a hit. So if you're trading commodities, steel, aluminum prices are worth watching. So US steelmaker has already jacked up their prices by 35% since last year, fueled by tariffs. So steel, that's like the main ingredient in so many industries, and the prices of the main commodity like steel is going by 35%. That's big, guys. That's really big. So the big question is how long this lasts. So right now, tariff, we're in the middle of the 90-day pause ending and ending this end of this month. So we might see more companies announce price hikes as the deadline is coming to a close. And if inflation keeps climbing, Fed might get aggressive with rates, which could shake up everything from forex to bonds to stocks, everything. So what do we do? What do we do as a consumer? So we need to shop smart. We need to look for deals before pre-tariff inventories run out. If you have a big purchase like a TV, fridge, car, now is the time to go out. And even if you have to kind of squeeze yourself a little, do it now before the tariffs get implemented. So it's like go if you have a big thing that's available at Home Depot, buy it now. As a trader, stay nimble. Monitor USD pairs for tariff-driven volatility and watch earning reports for companies like Walmart, Nike for clues on how they're handling their costs. If we're in commodities, steel and aluminum could see more upside. So we're tracking these trends closely. So make sure you're part of these lives on a regular basis so you are updated and things won't take you by surprise because we here, I especially, that's what I do all day long. I go through news, I go through what's happening in the marketplace, and make sure I bring you guys up to speed on a regular basis. So that's it for today. I think I made a comment that I'll cover China. Let me see if I can bring up that PDF, that slide deck, and real quick. And if I can, then we'll talk China a little bit. Just bear with me for a second. We will talk China as long as I can find my. No, that's gold. That's China. Okay, here we go. All right. So that was on July. I covered this on July 22nd, but we'll talk again today a little bit about how things are happening in China. So China is getting hit by every direction. Demographics being the biggest problem with China. The demographics are actually falling off the cliff. The population started shrinking from 1.4 billion to downwards in the year 2022. Even though the shrinkage or the numbers are kind of low right now, they're only like say about they're shrinking by a million or 2 million a year, but the trend is actually getting stronger. And I've got some interesting numbers for you because I looked it up just before today's call. And let me make this full page. Yeah, it was full page. Okay. So now the biggest thing hitting China right now, which is going to make it go bankrupt and into a collapse, is demographics. And we're going to talk more about that. Second is the housing bubble. The prices are already down by 25, 30, 20% of from their peak, and the housing is around 30% of the GDP. So now China as a country has to survive. So what do they do in the meantime? They are forced to sell treasury bonds. So the bond markets are being flooded because China has to now raise money to survive. Okay, it's not like China is selling bonds because they're not happy with the US. That's what everybody says. Hey, China is dumping US bonds because they want to punish the US. No, China is dumping bonds because they have to, not because they want to. That's the biggest thing people do not understand, people do not realize, because China does not have a choice. China is in a deep, deep hole right now. So they're putting up a front, which I commend them for that. It's really, really, smart the way they're playing it. And all these things combined. So the housing bubble has burst. Now, the demographics are going bad. Now, the companies are not, because of the tariffs, are losing the orders. They're not manufacturing as much they used to. So what is that doing? It's hitting stagnation. Everything is slowing down. So unemployment is going up, and then whatever money they pump in is never enough. And why does it matter? Because China is the factory of the world, and if they slow down, they don't have capacity to make. Because right now, think about it logically, guys. So all these factories, if they don't get orders, they start shutting down. What happens? It's not very easy to reopen a factory when the demand returns. It takes time. What happens in the meantime? Other countries, the competition comes up, like Vietnam, India, Philippines. Everybody is there to take China's capacity away from them, just because China going forward won't be able to man these factories. And China as a culture is not a very immigrant friendly culture. So that said, by year 2050, China's aging population, there will be over 400 million people over the age of 65. So now you have this huge, and all that is coming from one-child policy. So they'll have this huge old population to take care of, and there are not enough kids or not enough young people to take care of that older demographics. It is a nightmare. It's a nightmare. And they're building, again, don't even get me started as to how many houses they actually built. So the prices in the month to month prices are falling by 6 to 7%. I'm not talking yearly. I'm talking monthly price decline is anywhere from 6 to 7%. This is actually really, really, really big. And then one of the biggest developer, Evergrande, they liquidated. They went bankrupt with over $300 billion in debt. And then there is unsold inventory in China of about 93 trillion wons or RMBs, equal to 13 trillion. And we're not talking billions here. Now we're talking in trillions of apartments, these buildings that are just empty. Nobody's buying them. People who bought them, they just walked away from them. And these are these ghost cities that you keep seeing in documentaries and in news all over the place. So China, when it comes to property, they're done. When their demographics, they're done. So again, in the year 24, when just coming out of pandemic and everything, they sold 20% of mortgage-backed securities that they held. And what that did was raise the mortgage prices in the US and rest of the world. So the borrowing cost got raised because China decided to sell their bonds. Why? Because they had to, not because they wanted to. So if we look at it, so everything put together, this is a perfect storm. So now the people in the housing industry, they're out of job. Orders slowing down because of tariffs, unemployment higher. So no matter how you look at it, it's a perfect storm for China in the upcoming years. It is going to be very, very challenging, and it is going to be very difficult for them to come out of this in a good way. I just don't see a good ending for this. I don't see a solution for the demographic cliff because people are not having enough kids. Because they cannot afford to, because things are so expensive. Government policies are such, they're not happy with the lack of freedom. Again, I don't want to get into the politics of things, but people in general are not happy in China and they want out. As a country, I think China is done. The best of the China is behind us. Everything's going forward. China, I think here is the stat I was telling you about. By end of this century, okay? By the end of the century, China's population will be cut in half. Let that sink in, guys. There are 1.4 billion people. Out of those, 700 million people will be gone. Now imagine all that capacity, all those infrastructure, everything that was built for billions, and now we're talking hundreds of millions. It is going to be an absolute disaster. I don't see China as a country surviving. It'll break up into different parts. I don't know. I don't want to get there. We'll talk about my conspiracy theory on another one. But I don't see China surviving in its current form, doing what they're doing now for too much longer. maybe a decade max. That's about it. So that's it. I think that's everything I wanted to cover today. I will come back tomorrow at the same time. All right, guys. So I'll see you tomorrow. Have a great evening and have a good day. Bye.